The foreign exchange or Forex market is the world's largest financial market, and it plays a vital role in the global economy. Every day, trillions of dollars are exchanged from one currency to another. This kind of currency exchange is essential for international business. Forex market participants include governments, businesses, and of course, investors. Investors use the Forex market to speculate on changes in currency prices. Currency prices change almost constantly during the week because the market is open 24 hours a day in different parts of the world, from Sunday 5 p.m. until Friday 4 p.m. Eastern Standard Time. At any point in time, there is at least one market open, and there are a few hours of overlap between one region's market closing and another opening. The international scope of currency trading means there are always traders across the globe who are making and meeting demands for a particular currency. Now let's go over some basics of how trading Forex works. When you trade Forex, you're not just trading one product. You are trading two currencies against each other, and this is known as a currency pair. The quote for a Forex currency pair defines the value of one currency relative to the other. The easiest way to understand any quote is to read the pair from left to right. Let's look at an example using the Euro versus the US dollar currency pair. If the EUR/USD is trading at 1.10, that means 1 euro is equal to 1.10 US dollars. Another example using the US dollar versus the Canadian dollar currency pair. If the USD CAD is trading at 1.26, that means $1 is equal to 1.25 Canadian dollars. Even though there are two currencies involved, the pair itself acts like a single entity, similar to a stock or commodity. And just like when trading stock, investors profit when they buy a currency pair and its price increases. Investors can also profit if they sell or short a currency pair and the price decreases. Now that we've covered the basics, let's look at a few key aspects of the Forex market. We'll start with margin. When you trade on margin, you only need to put up a percentage of the total investment to enter into a position. This amount is known as the margin requirement. Forex margin requirements vary depending on the currency pairs and the size of the trade. Currency pairs typically trade in specific quantities known as lots. The known lot sizes are standard, mini, and micro. Standard lots represent 100,000 units. Mini lots represent 10,000 units, and micro lots represent 1,000 units. The margin requirement for most currency pairs averages around 3 to 5%. To understand how margin is calculated, let's look at an example using the Euro versus the US dollar pair. Say this pair was trading at 1.20 and an investor wanted to buy a standard lot or 100,000 units. The total cost of the trade would be $120,000, and that's a lot of capital. However, the investor doesn't have to pay the full amount. Instead, he pays the margin requirement. Let's say the margin requirement was 3%. 3% of 120,000 is $3,600. That's the amount the investor needs in his Forex account to place this trade. This brings us to another key element of the Forex market: leverage. Leverage enables investors to control a large investment with a relatively small amount of money. Leverage is the use of borrowed funds to increase one's trading position beyond what would be available from their cash balance alone. The leverage associated with currency pairs is one of the biggest benefits of the Forex market, but it's also one of the biggest risks. Leverage gives investors the potential to make large profits or large losses. We reviewed just a few elements of the Forex market. As with all investment opportunities, the Forex market has a unique set of risks and benefits. And education is the first step to determine if this is the right opportunity for you.